Our club has always been a forum for public figures, thought leaders, and decision makers to share their ideas. Here, we offer access to dynamic political, business, and public personalities.
We are dedicated to encouraging debate on the issues that matter to this city, this province, and this country.
The Canadian Club is one of the most important podiums anywhere in the world that a Canadian can speak to, tell Canadians what it is that they think, develop those thoughts. And so I want to thank you for that very, very much.
Please join me in thanking our esteemed panelists today.
Through our programs and events, including our youth and young leaders programs, our diversity partnerships, our joint events, and our media and social media opportunities, we offer you access to dynamic political, social, and business figures from abroad and right here at home.
The platform from which the eloquence of Canada has flowed all of that time, whether it be business, education, politics, sports, arts, and culture. If someone wants to say something to Canadians about this country and about the future of this country, this is the venue you choose.
Good afternoon, Canadian Club members and guests. My name is Jennifer Dewar-Thomas, a director of the Canadian Club, Toronto. I'm honored to be your host today. I'm grateful to those who are joining us online, and thanks to the AV services of Van Valkenburg Communications and livemeeting.ca. A warm welcome to all of you. At this time, I'd like to thank SimCorp, represented today by Jasper Cordis, for their generous sponsorship of today's event. Last week, we announced our partnership with Canada's Forest Trust, a leading ESG company planting smart forests to take action on climate change with the power of nature. We are proud to share that this partnership will help reduce the carbon footprint of our entire season of the Canadian Club Toronto events. Like all Canadian Club events, we are interactive today. If you have a question for our guest, please use the Q&A cards at your table. We will collect them and bring them to the stage. For those of you joining us online, hit the question button on the right-hand side of your screen during the broadcast. The sooner you can do so, the better. It's now time to introduce today's panelists. First, we have Hall-Kimm, Senior Managing Director and Head of Global Private Equity at HOOPP. Lori joined HOOPP in 2022 as the Head of Global Private Equity. In her role, she leads the private equity team and is responsible for the strategic, operational, and investment activities for private capital. Prior to joining HOOPP, Lori spent 6 years with CPP Investments, most recently as Managing Director of Direct Private Equity. Next, we have John Love, Founder and Chief Executive Officer of KingSett Capital, Inc. As the founder and CEO of KingSett and a which is a Canadian private equity real estate investment business, John creates and co-invests in real estate investment solutions. Founded in 2002, KingSett has raised $15.4 billion of equity for its growth, income, urban, mortgage, residential development, and affordable housing strategies. Third, we have Mark Wiseman, Board Chair at Aimco. Mark is a leading investment manager and experienced corporate executive. He was formerly President and CEO of the Canadian Pension Plan Investment Board. He was Global Head of Active Equities for BlackRock, Inc., and Chairman of BlackRock Alternative Investors. And he also served as the Chair of the firm's Global Investment Committee and on its Global Executive Committee. Moderating to the discussion today is my fellow Canadian Club Director, Andrea Mandel-Campbell. Andrea is a Senior Business Executive, Strategic Corporate Advisor, and Communicator. Currently, Andrea's on the advisory board of Crown Realty Partners and is an operating advisor with Vertu Capital, and is the founder of a new sustainable adventure travel startup called Caribou. Andrea, panelists, the Canadian Club podium is yours.
Great. Thank you very much.
So we originally talked about this amongst the Canadian Club back in July, thinking, you know, things are getting a little uncertain and volatile, and we usually have our outlook, an economic outlook in January, and we thought we can't wait till then. I wrote questions last week preparing for this panel, and I've actually kind of had to redo them as of this morning because things are changing so rapidly. The news out today, of course, is the UK is in full flight meltdown. And that's in addition to what happened last week around threats of nuclear war, call up of Russian soldiers, and we know that the Fed, which has already had 3 successive rate hikes, has now actually revised their plans and are actually looking at a 100 basis point increase in the next little while, which is completely unprecedented. So I'm going to start with you, Mark, and the question. At first, my question was, how are you looking at things when really I think the question is not a hard landing completely inevitable at this point?
Well, thank you, and delighted to be here. For those of you who are in the room, if you look up above your head, I notice there's a couple of bulls painted on the ceiling. That may be the only 2 bulls maybe in the world. Certainly at this meeting. Look, you know, one of the things I've said is it possible for there to be a soft landing? And you know, the expression I've used, yes, is it possible to parallel park a car at 60 miles an hour? It's possible, but highly unlikely. And what's more likely is that there's going to be a lot of damage done in the process of trying to do it. Where we are today is in a situation where central banks, and there's a lot of focus on central banks right now, central banks have 2 choices. They have a bad choice, and on the other hand, they have a bad choice. And so door A, essentially, if you are a central bank anywhere in the world, is to increase rates dramatically, to continue to increase rates dramatically to get inflation under control. The problem is that the type of inflation that we're facing today is highly structural in nature, and therefore the elasticity of an interest rate increase to inflation is quite low. So in other words, you don't get a lot of bang for your buck. And when I try to explain this in simple terms, you know, one of the issues we have is contention in labor markets. Raising interest rates isn't going to create more human beings. So you're still going to have the same problem in labor markets unless you crush demand. So that's door A. Door A is raise rates, continue to raise rates dramatically to get inflation down to target, and in doing so, put the economy into what could be a deep recession. Door B is we're going to actually move away from our long-stated policy position. We're going to accept some higher level of inflation and stop raising rates. Also a bad outcome because we all know that inflation, once it sets in, is very persistent because it's expected in the economy. So each time you go and renegotiate a contract, if inflation's always 5%, every year you ask for the 5% increase, it's almost impossible to break the back of that as it continues. And you know, let's not make a mistake. Inflation is a bad thing. It creates all kinds of disequilibrium in economy, and who does it hurt? In a world where we already see the effects of income and wealth inequality, inflation exacerbates that, right? It hurts people on fixed income. It hurts people who are trying to feed their family and can't afford it. It hurts those that can least be in a position to weather the storm, and further creates inequalities, financial and otherwise, in society. Those are the 2 choices. Now, the central banks are, particularly the Fed and the Bank of Canada, are indicating door A. And that's, if I was a central banker, I'd be doing exactly the same thing, because until you choose door B, the best thing to do is to make everybody think you're going to door A. And so, you know, we'll see by the end of this year whether there's a pivot to door B. The risk in door B is not only persistent inflation, but actually persistent inflation with low growth. And that's kind of the worst of both worlds. So, you know, it's really tough out there. We may get into a discussion a little bit about the added problem of disequilibrium among the large economies in the world. Mm-hmm. You've got sort of what's happening in North America, which we just described. We've got a different set of issues related but different in Europe, where much of the inflationary pressure is much more energy related. So a different type of structural problem and a very serious war.
Yeah.
And then the third economic bloc, which I think we're going to get to later, is China, which has got exactly the opposite problem, right? They've got a growth problem, and they've got to stimulate like crazy lower rates, inject capital into the economy to drive growth. And so now you're in a position, not only do we have the door A, door B problem, but we actually have the world moving in different directions. And if you think currency markets are roiled in the last few weeks, like hold on tight, because it ain't going to end.
Right. So if we kind of jump off on that concept around the structural changes, Lori, I'd like to ask you a little bit about that, because, you know, to Mark's point, there's some inelasticity in what we're seeing, and it's almost like we're pushing against something we cannot fix. I mean, in terms of what's happening with energy, what's happening with like the deglobalization aspect of what we're seeing and what we're seeing with supply chains. This is not just a moment in time. This is actually a remaking, a resetting of the global economy. What does this mean? I mean, how should we be thinking about it? Because it's really, the precedent is completely different, and I'm not sure if we've seen one like this in 100 years.
Yeah, completely agree with that. And I think one of the most important points on the structural changes is that they take a long time. And this is not something that it will be corrected or reversed overnight. And I think ultimately part of the question I think baked in there, Andrea, are we in a permanent price elevated situation? And I think when you look at it, thinking about global supply chains, and if I start there, historically, those decisions, particularly around the move to globalization, was an economic decision for most companies. And now that decision is no longer just an economic one, it's a political one, and it's about the security of the supply chain. I think companies, consumers, everyone has felt the pain of a challenged supply environment, and we've seen what that's done. And I think this structural reform is necessary. It's certainly, and by definition, it is inflationary, but I think for many of us, that's a cost that we'd be willing to accept in exchange for the control and security over supply chains, because the pain on the other side of that is as great, to Mark's point around two bad choices. So I do think it's here to stay, and it's going to take a long time to work that through. It's not all bad news, and I think from our perspective at HOOPP, and certainly with my private equity hat on, there are companies that will win in this situation, and there are sectors within the economy that will win. I think when we look at it at a macro level, we're thinking about moving increasingly into inflation-hedged asset classes. To the point we're here to pay pensions. At HOOPP, we are singularly focused on the pension promise, and we need to deliver that pension security. So inflation is bad for everyone, but it makes the role of delivering that pension security much, much harder. So I think for us, moving asset classes or moving assets into inflation-hedged asset classes like infrastructure, like real estate, and to a lesser extent, but equally, the long-term perspectives that we get from private equity has been a big focus for the fund. I think the other part of it, in terms of winners coming out of this, is companies that have been quick to move and take control of that supply chain, bring the nearshore, onshore supply chain back into the mix. Although they're having to deal with inflationary cost base, I think they will be better positioned. And from a competitive standpoint, those who do that more quickly have an opportunity. We've seen that in some of our portfolio companies, in fact, where being able to provide your products to your customers when your competitors may still be scrambling to reposition their supply chain has been a great opportunity for them to grow.
Can you give us a few examples of companies or specific verticals?
Yeah, I mean, listen, without going into individual names, because I think there are several winners across the category, but from a consumer perspective, we certainly look at a lot of the CPG companies, and I think some may know we have large consumer exposures in our private portfolio. And I think from that perspective, a couple of our largest assets have two things going for them. One, they have strong, recognizable brands, and that gives you pricing power that allows you to increase prices in an inflationary environment. And I think we've seen that with the CPG companies as well, not just keeping pace with inflation, but in some cases outrunning inflation and actually delivering growth on the back of that. So with a strong brand, you've got pricing power. The other thing, a couple of certainly our portfolio companies, and I know others out there have got, is capacity and being able to deliver that product without having to scramble, because going out and building a new plant right now, that's a lot harder than it was 2, 3, 4 years ago. So if you've got that built-in excess capacity, there's a great opportunity for you to lean into that, and again, be there when your competitors may not be able to. The one other opportunity that we've seen, as you look at repositioning supply chains, is there's a number of companies that will be the service providers in that ecosystem. And for us, we look at capital opportunities to provide growth capital to those companies who need to build out that local supply chain onshore, and there are great opportunities in that. So there are certain places where it's not all doom and gloom, but I think from a consumer perspective, that's going to be felt for a long time.
Okay, and I have to just follow up with one more quick question before I get to John, which is jurisdictions. What geographies are you looking at or staying away from?
Yeah, so as a fund, we are global investors, and given our scale, that's necessary. We really do need to look globally for opportunity. And I think, listen, we're certainly cautious when it comes to the geopolitical uncertainties in China. We're certainly wary of what I think most people would agree is likely to be a very difficult winter in Europe. And that is, but those are places where we have to look for opportunity. And Asia's a big region, right? So China is obviously, the elephant in the room, and you can't talk about Asia without talking about China. But there are opportunities in other parts of Asia where we have some exposure in our portfolio. And certainly when it comes to Europe, again, we've got exposure there, but North America is a big part of the overall portfolio, and certainly that's the case from a private equity perspective as well. So I think what we look at is global exposure, finding those opportunities, and even in challenging markets like we're facing, there are still opportunities to be found. And when you pick your places, I think you want to have a perspective that looks at the total picture. And as a pension fund, we can do that over a very long period of time. So it's very uncertain right now, but as a pension plan investor, we're thinking in quarters, years, decades, not days and weeks.
Right.
So we can take a longer term perspective on some of that.
Okay. Well, in Toronto, I know we're used to thinking in shorter terms when it comes to real estate, because we have seen an unbelievable run-up, at least at a residentially, in the value of a lot of real estate, and I'm sure in other ways, in other sectors as well. But John, I would love your take. A lot of the newspaper headlines are around the doom and gloom of how much, the value of real estate has dropped over the last little while, but Lori's talking about the opportunity in real estate, and I'd love to get your sense of how you're seeing things.
Well, first of all, let's start with the macro background, which is, Canada's population is growing pretty rapidly because of our, what I think is a quite good immigration strategy, and Canada is really alone in the G20 in having open doors in an immigration strategy. So last year, there's another 500,000 people in Canada, continue to grow. I posted something today on LinkedIn, and it was talking about 3,000 people a day is the added population, which is a pretty awesome number to think about. So, you've got a growing population, and a growing population needs everything. They need a place to live, work, shop, play, recreate, et cetera. So, all of that drives demand. Secondly, what Laurie was talking about. We're in a period after having 2 generations of globalization. We have, that game's been changed, and I don't think this is something that will be fixed or corrected. This is a permanent change, my view, into a regional trading blocks, which means we've got onshoring or nearshoring of almost everything, and that's going to have its demand impact again throughout the business cycle. As to the point, businesses look to shorten their supply chains, and security trumps price. So you've got those 2 demand drivers. At the same time, on the supply side, you've got restrictive land use requirements that make land in this massive country actually scarce. And so, that's, and you've got inflation, particularly construction cost inflation, largely driven by labor shortages, that's dramatically increasing the cost of new supply. So that's an incredibly important macro backdrop. And you have to look at real estate not on a day-to-day basis. I mean, these headlines you read in the newspaper, 99% of them need nuance, because sometimes they talk about the average sale price of a house has changed. Well, the average sale price is just the average of those houses that sold in that period. And it's quite possible, which is what we've seen over the last 6 months, that the number of houses over $5 million that are trading is much less. So therefore, the average price is by definition dropping. You also then have to say, well, let's take a huge long-term view, like maybe 12 months. Well, the average price in Toronto over the last year is still up. And you have to read the whole article, which, of course, for many of you is behind a paywall, and who's going to spend that money? But anyway, so the fact is that what we did have in the 90 days up till the end of February this year, sort of a speculative blowout. And you know what? Take those 3 months and throw that in the garbage. Look at a 12-month period. Look at what's called HPI, which is the House Pricing Index, which says, it compares a 4-bedroom, 2-story house to a 4-bedroom, 2-story house, and the story is much better. But the other thing I'd say about a house is a house, is by definition not a trading asset, right? You buy it for all sorts of reasons. You hope to, over a generation, live your life and perhaps, create some value, but it's not a trading asset. So so that said, I think long-term housing prices can only go up because you've got demand exceeding supply. And this is economics 101. More demand than supply. That's not going to change. You've also got inflationary pressures. In an inflationary environment, not that this is a sales pitch, but we're here, real estate is being in hard assets is always proven to be, a constructive protector of capital.
So, and looking at, industrial office, how are you looking at that space? Everybody's talking about return to work. What's your...
So all the asset classes are a bit different. I mean, multi-res and industrial sort of share the same issue of excess demand and super difficult land use planning, so supply is difficult. Retail's interesting because the nature of a mall store, for example, has changed. It used to be you'd go to the mall and it would be a point of sale, a store would be a point of sale. Well, now it is a service depot, a return depot, it's a last mile distribution point, it's all sorts of different things. So actually mall retail is showing some pretty interesting strength. As to office and the return to office and noise, it's more informative to me what tenants are doing. And tenants are not giving back space. Tenants, the very large tenants, are giving back some peripheral leases that are not in the downtown core. But in our portfolio, it's a little over 5 million feet. There's no one asking to give up space. Now, utilization is less, but leadership in every business wants their people back. And the people that are suffering the most are the young people who don't understand what they're missing, because what they're missing is building their toolkits, their relationships, the opportunities to learn from their mentors, culture, and all those other things. And I think the gravitational pull of the office will bring most people back most of the time. Now, that said, the 55-hour or 50-hour whatever work week is probably a thing of the past. But I think that the bigger issue there is there's a lot of people who don't want to work 5 days a week. So I think that model will evolve, because I think we'll end up with, and every business will have a different kind of model, but there will be some kind of a hybrid basis. I mean, for us, you know, we have 2 flex days a week, but they're Saturday and Sunday. So anyway, you know, because I sort of think.
Can I come work for you? No.
The fact of the matter is, we're trying to work hard for all sorts of different customers, and those customers expect a certain performance from us, and it's important. It's actually a full-time gig. So but that said, I think flex work is going to evolve. We've always talked about flex work being that, if you've got life interrupts, your work schedule. So if you've got to do something, go do it. But I'm not sure how many people actually took advantage of that. I think that model is finally changing, so that if you have a sick child, or the plumber's coming, and the plumber's or you're getting cable in the afternoon, whatever, people work from home, and I think that's a really constructive change, because that respects people's lives outside of an office, which is an important thing. So it takes all that stress away. And so while we have, as leadership at our business, talked about that before, I'm not sure people believed it. Well, now people believe it, and I think that's a good thing. But there will be a flex model that will be different for every business, and that's okay too.
Interesting. I mean, it'll be interesting to see how things change when unemployment starts to rise. And up until very recently, it has been an employees market, and I do think that's going to change a little bit as we see things change.
It's 2 points. It's an employee market, but also there's you sit there and say, well, where did all the workers go?
Where did they go?
When did working become a lifestyle choice? And it turns out that there's been a major reduction in participation in the over 55 category. So a lot of people retiring early or leaving the workforce.
They're in Collingwood, I think.
Well, I think many of them
working from home.
I think many of them, settled into a routine and said, you know what, maybe I don't have to go back, because maybe we can make our nut work, and whatever. Inflation is going to scare some of those people, because that's a real threat, and we will have a jobs recession. I mean, clearly, our central banks will be unrelenting until there's a hard recession, right? A hard landing.
So, John, I'm going to pick up on that point a little bit and make 2 points. The first is the demographic point, which is we've known that we were going to have a labor shortage, not just in this country, but generally in the West, in particular in Europe. It's been coming for a long time. The amazing thing about demographics is that it is the one thing that is entirely predictable. If you know how many children were born in the year 2000, you know how many 25-year-olds you're going to have with a great degree of certainty in 2025. And so this issue around the labor shortage is not new. Demographers, economists, and others have been talking about it for a long time. And all that COVID has done, like many other trends, is it's accelerated that. It's probably accelerated by 8 to 10 years. And yes, there's less people participating, but actually, particularly in the US, people died. Probably somewhere in the neighborhood of 3 million excess deaths in the United States. If even 10% of those people were participating in the workforce, that's a huge number of people, because it's the marginal cost of labor that matters in the system. So we were going to have a labor shortage problem. That's why people, including me, have been advocating for high immigration levels in this country for a long time, because we saw it coming, and it's come a little bit earlier, and it isn't going to go away. So let's face it, unless we do something about the structural issues, they're not coming back to work, and a lot of them aren't coming back to work because they're dead. Okay? So that's the first point. People die all the time. A few more of them have died. A few more of them died a little bit sooner than was anticipated by the models. But the models all said we were going to have labor shortages. And that brings me to a second point, which is, and really, John, it's what you're talking about, and some of it's a little bit tongue-in-cheek, but it's incredibly, incredibly serious. We have a productivity problem, and the productivity problem has gotten worse, not better. In spite of the tools that we have available to us through virtual meetings and a greater use of technology and so on and so forth, productivity was basically flat and down during COVID, and it really hasn't picked back up. And in fact, there's a particular productivity problem in this country. We're now running at about 70% of labor productivity in Canada versus the US. That is a massive gap. We've been talking about it for a long time.
For a long time.
And unless we address the structural issues around productivity, and that involves the use of technology. That involves reskilling and skilling our workforce appropriately. That means incenting labor appropriately. It involves government policy to encourage investment in research and development, and it also involves the private sector, so let's not put it all on the government, getting serious about driving productivity growth in this country. And if we don't do that, particularly in an environment where labor markets are, in spite of immigration, going to continue to be tight, if we don't do that, that gap is going to continue to expand, and Canadians are going to be relatively poor, continue to be relatively poor, as we have been, by the way, for the last 25 years, to our neighbors to the south. And so the points you make are really, really important, John, and I completely agree with them. But we've got to take in this country the productivity head on, and it's the only way that we're actually going to solve this. And by the way, you can't put that on the central bank, right? There's lots of things you can blame central bankers for, but you can't blame them for productivity.
But Mark, is there,
fiscal policy.
Sorry, but is there not also, something that we need to shine a light on with regards to productivity, which is the excessive regulatory burden and requirements? We don't have free trade, we don't have interprovincial free trade. I mean, there's so many barriers.
100%, I agree with
to unleash, and those are quote simple close quotes things to fix, but our disadvantages. I mean, we can't build a building, we can't fix the supply chain, we can't accelerate solutions because we can't do things. And when we do things, it is the regulatory oversight and burden and requirements are exhaustive. I mean, everybody talks about cell phones. If we had U.S. Cell phone prices, wouldn't that be great? Well, maybe if the U.S. carriers had to have Canadian regulations, maybe it'd be a different discussion.
Well, or maybe if we allowed competition in this country, but that's another conversation.
That's
right.
But
if the competition had to play by the same rules.
And just to jump in on this, I think we're in a really interesting moment in time because the structural changes that we're going through right now, and I think the uncertainty that we're facing is creating the urgency around some of those issues that you've talked about. And so I think there's an opportunity right now. Necessity is the mother of invention, and it really gets the creative juices flowing. And I think right now there's an opportunity for all of us as investors and capital providers to fuel the economy, and also as policymakers to address that. And maybe in the past there's a sense that it wasn't that urgent. The urgency cannot be denied, and I think in this environment, it does provide a bit of a catalyst to tackle some of those issues.
And what I said, Lori, I'm on the exact same page as you, and John, I completely agree. And my point is, everybody right now is talking about central bank policy.
Yeah. Right.
What we need to be talking about is fiscal policy. Central bank policy at some level is going to be what it's going to be. Fiscal policy is what will, including regulatory environments, et cetera. And again, just look at what our neighbors to the south are doing, with things like the interestingly named Inflation Reduction Act, but also things like the CHIPS Act, which is encouraging the type of productive growth that's required. And it's not happening here. And if it doesn't happen here soon, that gap is going to get bigger, not smaller, as it has done for now almost 3 decades.
And one of the reasons I think everyone's talking about the central bankers is because what they have to do affects us on a daily basis. It's the here and now. And some of those fiscal policies they need to happen now, but that's a long-term game. And I think you need both. Completely agree with you, Mark. But I think part of the distraction is the noise that we're seeing on a day in and day out basis.
But I think part of the challenge is, frankly, Canada could not do anything urgently if its life depended on it. I mean, it really couldn't. I say that because I wrote a book, 17 years ago called Why Mexicans Don't Drink Molson, which was about our lack of productivity, all the regulatory issues that we have that constrain business and push down entrepreneurism. So my question really is, and we had that, I don't know how many people in this audience read that piece in the Globe and Mail back in April, where you had the CEO of RBC actually coming out and saying, this is a tax and spend government that all it's looking to do is redistribute wealth and can't figure out how to actually come up with a growth agenda for our country. So when he's saying that, you know there's a problem.
Right.
So I guess my question is, if you had to, if you had the ear of our policymakers, what would be the one or two pieces of advice that you would give? John, I'll start with you.
Well, if I was going to do one thing only,
yeah.
I'd say Canada has an obligation to be an energy superpower. We have an obligation to share our excess energy with our allies and friends around the world and use our excess energy to disintermediate coal globally. We could use our excess energy to eliminate all of Canada's current greenhouse gas emissions. So I'm not interested in shaving 1.6 to 1.5%. Let's reduce the world's by 2%. We could do that easily by using our excess energy. And every province has a dog in this hunt. So whether it's gas in BC, oil in Alberta and Saskatchewan, uranium in Saskatchewan, ring of fire here, et cetera, everyone has got something to do. We could galvanize this country, because it's actually the only country in the world, free country, that has so much excess resources. And we could galvanize that, be an energy superpower, to protect our European friends from ultimately being cold in the dark, and to disintermediate coal and really have an impact on climate change.
Lori.
So I think the thing I would call out, and I think that article that you were referencing was just before the budget came out.
Yep.
And then we saw in the budget some spending allocated toward innovation and green technology. And I think it was $56 billion or thereabouts. And people will debate whether $56 billion over 6 years is too much or too little. Certainly, I don't think anyone would say it's too much. But when I look at it at HOOPP, the focus on innovation and growing our exposure across venture and innovation globally, but equally as much in Canada, I think is a real opportunity for us. So policies like that and spending commitments like what did ultimately come out in the budget, I would say more, please. That's a great opportunity for Canadians to solidify their position as a talent and innovation hub. And I think we, obviously with our friends in Silicon Valley, we're always going to be, in the shadow of a big brother. But at the same time, we do have a flourishing and growing ecosystem of innovation and venture in Canada. And I think the more we can do to support that, the better. So that's been a real focus area for HOOPP. And that's something that we've collaborated on across asset classes. So I'm thinking about it from a private equity perspective, but I'm working with colleagues on fintech and in the public markets, really trying to bring all of our expertise to the table to say, what can we do as a source of capital who is focused on generating long-term returns? What can we be doing to support innovation? And I think any policies that go to support that, like the start that we saw in the budget that ultimately did come out in April, is a great place. So more of that, please.
Mark.
Yeah, I sort of take all of it together and say, what we really need to do is play to our comparative advantages, and we have a lot of them right now. The world has actually come Canada's way, and when you have an advantage, you should take it and aggressively exploit it. So what are those advantages? Certainly it's in energy. We haven't talked about agriculture. We haven't talked much about the transition economy and developing expertise both in technology, but also in the provision of capital to fund the global transition. And then the other big advantage that we have is our human capital in this country. John, you mentioned our immigration policies, which are standalone in the world. It's how do we get that incredible human capital working more efficiently for us? The diversity of our country is an advantage. An Indigenous community which is growing relative to the rest of the population, which if sort of turned on and utilized, can be a driver of economic growth. Training and reskilling our people. I wrote a piece recently in the Globe with Senator Hassan Youssef, the former head of the Canadian Labour Congress, and a lot of people said to me, you know, what are you doing, Wiseman? You're like the big capitalist guy writing a piece, you know, with Hassan. And I said, because, you know, getting productive value from human capital is as important as getting productive value from physical capital. And we can actually make businesses stronger and human beings more prosperous and more successful in their own lives. That all aligns very well, and we can do that incredibly well in this country. So we've got a whole bunch of really incredible advantages today. And the answer is, let's get aligned and exploit the hell out of them as a country while they're an advantage. They won't always be, but the world's come our way, sometimes for unfortunate reasons. You know, look at the agriculture sector and what's happened to pricing of certain commodities. You know, it's an unfortunate reason that the Ukraine, Belarus, and Russia aren't supplying what they used to supply. But guess what? We can. Markets are up. You know, I want to be the country that's like in Trading Places, the guys in the orange juice futures pit when everybody's on the other side of the trade and they're buyers. Like that's where we want to be. We want to be taking advantage of market conditions, and we got to be way more nimble, and we got to be aggressive about it. And we're not good at being aggressive.
Not good at being aggressive. No. There's a bunch of questions I have here, which I think I can kind of. This will be our last question, which is around. They're all kind of related in the ESG climate side of things, and I'd love if each of you could give a quick response. But it's really, you know, on the one hand, you know, we're on a short timeline. We know we have to make some major impact in a very short period of time if we're going to kind of manage this climate crisis. ESG seems to have kind of gone off the radar a little bit with everything else that's going on. I'd like to get a sense. It's kind of like the other. You know, the other ghost in the room is how should we be thinking about ESG climate? Can we afford to be thinking about this now? And have we lost kind of the momentum? Maybe Laurie, I'll start with.
Can we afford not to be thinking about this now is what I would say. I think we absolutely have to put climate and ESG considerations at the forefront. And I think on the social side, you know, we're seeing the effects of, you know, the tragedy with Russia and Ukraine, and there's social ramifications for that. You come a lot closer to home, and you know we've got equity, diversity, and inclusion considerations, and there's still so much progress that is needed. Lots of progress has been made, but there's so much more to go. And you talk about human capital, growing productivity, you need to include everybody in that equation if you want to make progress. And I think the way we've thought about all of those factors is that they should not be a sideshow, but core to our investment focus. So we have a sustainable investments team, but actually it's embedded in every single investment team across the fund, because ultimately I think the old way of thinking was that you needed to trade off returns in exchange for social responsibility. And now I think what we're seeing is they go hand in hand, and if anything, there's a negative carry if you're not investing in a sustainable way. So,
John?
So I think it's an interesting question. People that have sort of abandoned any ESG focus didn't really have an ESG focus in the first place, because they never understood why it was important. They didn't understand, I mean, that ESG actually has to be, you have to think through a lens of how does this make my business, my assets, whatever, more valuable. I mean, from our perspective, diversity is simple. Diverse teams make better decisions. This isn't complicated. This isn't a debate. That's a clear business rationale. Therefore, it's hardwired into our thinking. We're making this property, Royal York Hotel, 90 years old, carbon zero. It'll be carbon zero by this time, fourth quarter next year. we're not doing that because we think we're going to change the world or because we want a plaque somewhere. We're doing that because we think it's fundamental for the long-term sustainability and resilience of this asset. And we're convinced that customers will make either a differential choice or they might pay a premium, God forbid, because we are zero carbon. But this isn't our first foray into this. I mean, you know, Scotia Plaza is zero carbon. That was in Earth Day 2020, a lockdown. What an announcement. Anyway, but, you know, like this is going through our whole portfolio. Why? Because it's good business. It only makes sense to do it. And I think people that are backing away from ESG commitments were just greenwashing in the first place. And you can tell that when you read the ESG report, and it goes on for 176 pages, and you say, well, that was just alphabet soup. So, like, our focus is on deliverables, getting stuff done, making it clear to our customer that we're doing it, because we think it's creating value for our assets, our owners, our stakeholders, and our customers.
Mark, the last word to you.
Well, look, I don't have a lot to add. You know, I think it was over 20 years ago at Ontario Teachers that I hired this young woman named Lori Hall-Kimm. I hired her because she was really smart, and she's gotten only smarter over the years. But you know, I think the way that Lori described it from an investor's perspective is spot on. And you know, if there's one takeaway I'd say about sustainability, specifically in ESG more broadly, is we have to understand it's got to be explained on a spreadsheet, not on PowerPoint slides. And sophisticated investors have understood that for a long time. It's about both risk and assessing the risk in your portfolio from the lens of long-term impacts that it may have. And it is equally about finding opportunities that can be exploited, including in transition finance, and financing the transition to a lower carbon economy that will pay outsized returns. And so those who get it, like Lori and her colleagues, and actually a lot of the large Canadian institutional investors, both the pension plans and beyond, they understand that it's about being able to describe that on a spreadsheet in numbers, how it affects long-term returns, not with pretty pictures of windmills and PV arrays. So I think we get it in this country, and I think it's going to be, instead of having the political debates about it, actually it's going to create investment opportunity for Canadian investors disproportionately because of that.
With that, thank you so much. Thank you.
Members and guests, my name is Khadija Wasim, and I'm a director of the Canadian Club of Toronto. Lori, John, and Mark, I want to thank you for calming, or not calming, our nerves, sedating, I would say, and sharing your wisdom with us this afternoon. The biggest takeaways I have, John, is to make sure you read the end of the article. Lori, it's making sure that we are focused on an innovative and entrepreneurship-focused economy. And Mark, time and time again, you mentioned the importance of people and productivity. We've been inundated with so much change and uncertainty over the past few years, and economic volatility is definitely testing our resilience, and in this post-COVID economy, our patience. The insights you shared with us are so necessary and important. The information you provided will help us decide for ourselves whether we're in a corrective or in a reset phase. We appreciate your lively and rich engagement with us and wish you all continued success and prosperity in your respective roles. And to Andrea, you're my favorite. A communications leader extraordinaire, thank you for facilitating this very important and timely conversation. We appreciate your communications acumen and your articulate questions. Before we conclude, I'd like to take an opportunity to invite you to our next event on Tuesday, October 4th. We're featuring a dynamic virtual panel of experts to address the issue, yes, don't worry, I'll tell you, the issue of getting to the net zero carbon goals. So visit the CanadianClub.org for more information and to register today. We hope you can join us. I'd also like to thank and offer another round of thanks to today's sponsor, SimCorp. We appreciate your generous support of today's event. Our club's vision is to be the podium of choice for relevant and provocative conversations
connecting the business community and promoting an inclusive and prosperous Canada. We want to achieve this vision every single time that we gather. Thank you for helping us achieve this vision. Take care and see you next time.